Good morning, everyone. We'll give it a minute for participants to join.
In Milan, my video does not work, so I can't get on. It says host has stopped it.
Oh, okay. That is odd. Let me see if I can figure it out. Otherwise,
Yeah,
I
no
think
big
this will
deal.
work. Yeah. I've never encountered that before, but Zoom always throws in something.
Yeah, and I'm from a Teams shop, so I can't help you.
Uh, okay. All right. Well, I might go off video as well then, Mark. But
Yeah,
why
no
don't
worries.
I see people populating and joining in. So why don't I start with the introductions and then we will kick things off. And I am going to just note for everyone. So I want to thank everyone for joining this morning. I'm Milan Dalal, president of the Democratic Business Council of Northern Virginia, or DemBiz. DemBiz is a nonprofit that's dedicated to fostering a dialogue between Virginia's business community and Democrats. And if you enjoy this morning's programming, I encourage you to sign up for our membership at dembiz.org. This morning, we're joined by Dr. Mark Zandi, who is chief economist at Moody's and one of the nation's foremost economists. Mark is a longtime friend. We've had the privilege of working together on public policy issues and consulting with Mark for more than a decade. And I've always been very impressed by the depth of his research and the angles that he brings to very interesting public policy issues. And he's somebody that I call a public intellectual, someone that politicians of both parties often consult for impartial economic advice. So we're thrilled to welcome Mark here this morning. And Mark, thank you so much for joining us.
Thanks, Milan. Thank you for those very, very kind words. Public intellectual. I like that. I had not heard that before, but I'll take it. I appreciate it. Thank you.
Um, I'll start with some questions, and then I'll also try to work in questions from the audience. So,
Okay.
for the audience, if you have a question, please type it in the chat box below, along with your name and affiliation, and I'll try to work in some of the interesting questions into our conversation. Um, and this webinar will go until 11 a.m. And so I'll try to um, mix in a decent number of questions and then some audience questions. So Mark, maybe I'll start out with some macro questions. Over the last 4 years, we've seen an unprecedented collapse and then recovery in the economy with COVID and then the emergency response. The stock market today is roaring. Unemployment is hovering near historic lows at 4.1%. Real GDP growth over the past year is at 3%. You recently remarked, I think I read on Twitter that you said this is among the best performing economies in your 35 plus years as an economist. What do you attribute this to?
I to the strong performance, what's behind it? I think
Yes.
well, a few things. The thing that was really doing a lot of damage to the economy, obviously, was the pandemic, and then the Russian war in Ukraine. Those two, what economists call negative supply shocks, really hammered the economy, was behind obviously the loss of jobs, and then ultimately the very significant increase in inflation back in 2021 and 2022. And as those shocks have faded into the rearview mirror, at least in terms of their economic fallout, the economy has been able to find its footing and get kicked back into gear. And then we've been fortunate with a couple of what I consider positive supply shocks. The surge in immigration, while that has many costs and has been difficult for many communities across the country, the one significant benefit is that it has helped to ease labor supply problems, labor shortages in many industries, and allow the economy to grow without inflation. In fact, if without that immigration surge, one could imagine that the Federal Reserve would have had to raise interest rates a lot more than it did, and a recession would have been much more likely. But we were fortunate with the timing of the surge in immigration. We also have been benefiting from a rather substantive pickup in labor productivity growth, and that's another positive supply shock that was unexpected. A lot of debate as to what's behind it, how sustainable it is. But I do think, there are a couple of things that give us confidence, or at least give us some hope that it is more sustainable. There's been a very significant increase in the number of businesses that have formed since the pandemic. You can see this by looking at the number of applications for EIN numbers, taxpayer identification numbers. Businesses have to do that when they form, and we've seen a tremendous amount of formation since the pandemic across lots of industries and across most parts of the country. And that positive productivity increase is allowed the economy to grow more quickly with less inflation. And I'll also say a bit of a surprise on the supply side, positive was the surge in oil production. Oil prices, instead of going up as I was fearful of, they've actually come down despite the sanctions on Russian oil, and despite Saudi cutbacks in production. And that's because North American frackers have been able to ramp things up, and we're producing a record amount of oil here in the U.S., 13.5 million barrels a day, up about a million and a half barrels from where we were a year or two ago. And that's really allowed oil prices to stay down, and that's been really critical. So, it's the benefit of fading negative supply shocks and the benefit of some positive supply shocks. And then, I do think policy is playing a role. I do think particularly the infrastructure legislation, that's been very helpful in supporting manufacturing and construction activity, two sectors that generally get nailed when interest rates are up, as they've been over the past couple, 3 years. The CHIPS Act has been very helpful in supporting development in the chip industry, obviously, and supply chain resilience and R&D. And the Inflation Reduction Act is also kicking in, so that's also provided some help. So I think policy has also played something of a role here in helping support economic growth. But bottom line, pick your economic statistics, at least in aggregate. There's a lot of distinctions to be made across the economy, income distribution. Different demographic groups are doing better than others. But when you take the economy in its totality and look at the numbers, it's just really quite compelling. The economy is performing exceptionally well, and about as good as I've seen it in 35 years. I've been a professional economist.
A lot of great points that you made there. I think the one on energy production is really interesting because we hear a lot of demagoguery, I would say, around the U.S. energy production, but actually the point that you made that it's near record highs and has increased by a couple million barrels over last year's production is, I think, very notable, and obviously probably a reason why we see the discussion about fracking, particularly in Pennsylvania, so prominent in the presidential race. You raised a really good point about the policy and infrastructure and the Inflation Reduction Act and chips. And only some of that funding has come online already. So that I think the infrastructure bill is supposed to be doled out in increments through 2026. The Inflation Reduction Act also has a longer term horizon. And then chips, we're starting to see, part of the CHIPS Act included incentives, tax incentives for production and opening up manufacturing facilities in the United States. And so we're starting to see construction, but not all of that has come to fruition yet. So Do you think that's a buffer against a downturn? And are we going to continue to see that level of policy support for the next few years that should sustain the economy?
Yeah, I do. Yeah, and you make a great point that the spend out of those pieces of legislation, the infrastructure, chips, IRA, Inflation Reduction Act, are going to play out over the next year, two, or three. So there's still a lot of juice coming from those very substantive pieces of legislation and policy. The most interesting thing about, well, there's many interesting things about it, but one of the most interesting things to me is that the CHIPS and IRA in particular are using tax incentives to get the private sector to kind of ramp things up, to do things that are deemed to be important to the economy and national security. I mean, I view the CHIPS Act as much national security as I do, economic policy, because we obviously learned during the pandemic and in recent years, and given the tensions between the U.S. and China, that we can't, as a nation, remain dependent on Taiwan for chips. So,
Exactly.
very, very, very important from a national security perspective. But that support should, that getting the private sector to move in a certain direction has really been powerful. I mean, just to give you a statistic, to give you a sense of magnitude, if you go back in the 10 years prior to the passage of chips, I think what was Milan? Chips August of 2022. I'm trying to remember. I
Yes.
think, yeah, August of 2022. The infrastructure law was like the fall of 21, and chips was summer of 2022. If you go back in the 10 years prior to August of 2022, spending on manufacturing facilities, factories, let's say, but that would include everything from fab plants to, a food processing plant, was about $75 billion per annum. Pretty rock solid $75 billion per annum, give or take. In the last quarter for which we have data, Q2 2024, the second quarter of 2024, I'm speaking from memory, so I don't have this exactly right, but you can Google it. $225 billion at an annualized rate. I mean,
Oh,
that's,
wow.
yeah, amazing. And that gives you a sense of just how powerful, that piece of legislation has been in supporting growth. And just to reiterate an earlier point I made, you asked why is the economy kind of do as well as it did in the context of a Federal Reserve that's pushing up interest rates aggressively, is that, historically it's the manufacturing and construction sectors of the economy that take it on the chin, right? Those are the two most rate sensitive sectors of the economy. Rates are up, they're down. This
Hmm.
go around, they're not if I take manufacturing in its totality and I look at construction as across the board, it's not booming, but it's not declining. And that goes to these powerful pieces of legislation. So it's really kind of helped cushion the blow and allow the economy to continue to move forward. And it's not only about the near term, it's also about the longer term. Again, I mentioned national security, but obviously, the things that legislative actions are investing in, infrastructure, everything from roads, bridges, broadband, seaports, airports, the IRA, addressing the climate risk that we face. And you can see how damaging, climate change has already become, with Milton and Helene together, costing well over $100 billion, in property damage and lost economic output. So, these things are going to have long-lasting benefits. So I view them as investments in trying to support the competitiveness of the U.S. and keep costs lower than they otherwise would have been. So both short and long-term benefits.
Okay. And since you referenced interest rates, I maybe will ask a question or two related to Fed policy. And President Biden has taken a lot of flack for inflation, and I would say that he probably overdid it a bit with the third stimulus, but a good chunk of inflation was caused by the supply chain disruptions that you referenced, as well as unbelievably lax monetary policy. And I also recall the Fed buying, Fannie and Freddie debt while the housing market was soaring. The Fed missed inflation on the way up. Do you think that they're also missing it on the way down too? That is, are they too late in cutting rates? And some of the things that we referenced are buffering, holding up the economy because of the long-term spending, being doled out. But absent that, would we be in a more dire economic situation?
Well, I agree with you that the high inflation that we were suffering 2 to 3 years ago, really that was in the second half of 2021 into 2022. Since then, it's been moderating. Now we're back down to something that's consistent with the Federal Reserve's 2% target. That was the factors driving that undesirable inflation. There's a long list of reasons, but I
Hmm.
would put at the top of the list those negative supply shocks, the pandemic and the impact on supply chains and the labor market, and really underestimated, I think, is the impact of the Russian war. That caused obviously oil prices and natural gas prices to go skyward, caused agricultural prices to go up, and thus we're still paying, higher food prices as a result. And what happened was that those two shocks, those negative shocks, the pandemic and Russian war, conflated and jacked up inflation expectations. You can see that in early 2022 when Russia invaded. And that's when that began to infect wage price dynamics, and that's what caused the Federal Reserve to go on high alert. The American Rescue Plan, the COVID relief plan that was passed in March of 21, as you said, it was probably in hindsight, definitely too large. It was 2 trillion deficit finance. That was on top of already 3 trillion in deficit finance support that was provided in the Trump administration in 2020. But, policy 101 says that if you're uncertain about, what's going to happen, you err on the side of doing too much. In March of 2021, hard to remember back, but at that point, we were just starting to get the vaccines. The pandemic
Hmm.
was still raging, and, a lot of uncertainty. And there's also a lot of political uncertainty. I think the Biden administration was unsure. Well, suppose they went for a smaller package and things went off the rails, the pandemic went in a direction that no one could anticipate, and they went back to Congress. Could they get another package through Congress? And they were fearful they couldn't, the one bite at the apple, and so therefore they took a bigger bite, and it did cause inflation. It was behind the inflation, in 2021. But one other point about that I'll make, and then I'll move on to answer your questions explicitly, is that the inflation back in 2021 in the wake of the American Rescue Plan, that was actually deemed hard to remember back, but that was deemed to be good inflation. That was, because we had been through a period of suboptimal inflation below the Fed's 2% target since the financial crisis. And here we were, finally, the Fed inflation was above target, exactly what the Fed wanted. And there really wasn't much hand-wringing about it. It was only when Russia invaded and inflation got jacked up again that it became a real problem. And of course, impossible to predict the Russian invasion, which was February of 2022. It just came on the radar screen, very quickly and became a real problem. So, I think it's the obvious that it's the pandemic and Russian war, and clearly, given that inflation has followed the same path all over the world, that argues that it's something global like the pandemic and Russian war that are behind the dynamics, the inflation dynamics, not the American Rescue Plan, which was something here in the United States. Clearly the Fed did miss the pickup of inflation in 21. They didn't start to raise interest rates until early 22 when about the time Russia invaded. They still had the federal funds rate target, the key rate they control, at 0 going into 2022. And, all of the models that are used to gauge, what interest rates should be, the so-called, I won't go into it, but I'll just say it's just jargon. The Taylor's rule, which is the
Oh
rule
yeah.
the Fed uses kind of loosely to gauge the appropriate funds rate target, was saying that should be somewhere around 2 or 3% by early 2022. Now, again, they were practicing policy 101. If you're unsure, you err on the side of doing too much, but obviously, certainly in hindsight, they did too much. They should have been normalizing rates much more quickly. Fast forward to the current period, they are now starting to cut rates. They went from 0 on the funds rate to 5.5% in a year and a half. By mid 2023, they were at 5.5. That was the sharpest increase in interest rates, I think, on record, or something close to that. They kept rates there for a year until the September of 2024. And I was growing very fearful that they were going to make a mistake on the other side, keep rates too high for too long,
Mhm.
undermine the economy, inappropriately so. Inflation, is back down, back consistent with their low and stable target. But they cut 50 basis points, a half a percentage point in September. We're down to 5, still way too high. I think they need to continue to cut rates, so-called normalize interest rates, but they feels like they're on the way there. So I'm much less worried at this point about the Fed making a mistake. Certainly until they get rates back down to something consistent with so-called equilibrium, the rate that's consistent with policy, neither supporting or restraining growth. I think there's reasons to be nervous, but I'm much less nervous today than I was back in the summer when it looked like they were going to wait, and wait too long.
So I see a question in the chat box from Sunny Abasi, and I want to ask a variant of the question that is typed in there, which is that let's say inflation remains persistently high so that the Fed does not cut rates as aggressively as the dot plot now projects. Uh, do we risk having more turmoil in the banking sector the way we did with Silicon Valley Bank and Signature Bank last year, March of 2023? Just as a reminder for our audience, we had some financial institutions had essentially an upside down bond portfolio where they had locked in long-term investments at around 2%. And yet, banks will borrow at um, long-term rates, but lend at short-term rates, right? So they are, sorry, the other way around. They're borrowing at short-term rates and lending at long-term rates. And so they need to plan appropriately for their duration risk. And um, Silicon Valley Bank had this upside down bond portfolio where they had, you know, had made a bad projection about the direction of interest rates. And as the Fed began to hike, their bond portfolio ended up being underwater. That caused capital issues for them, and eventually led to the run on the institution. Mark, do you worry about anything like that repeating? And don't have to mention any institutions' names, but I've looked at some charts on some of larger financial institutions. There's certainly one very large bank out there that has a pretty bad bond portfolio. I think it's running off, every month in terms of maturities, but in terms of the size, it would be much larger than Silicon Valley Bank if it were to run into trouble.
Yeah, I do think as long as the federal funds rate is as high as it is relative to its uh, what I call the equilibrium rate, the rate at which policy is neither supporting or restraining growth, you're running a risk that something breaks somewhere, either in the economy or in the financial system. And the financial system broadly, the operating environment's difficult for many reasons, one of which you described, and that's the inverted yield curve, where short rates, because they're tied to the federal funds rate, are higher than long-term interest rates. So the federal funds rate's at 5%, the 10-year treasury yield's at 4. That's an inverted yield curve. And in
Mhm.
that operating environment, that's tough because, as you said, banks borrow short, lend long, and they can't do that as profitably or profitably at all if the curve is inverted. So as long as the curve is inverted, I remain nervous. And it may in fact be premature to conclude we've soft landed until again the Fed normalizes rates and the curve becomes more normally shaped. Of course, the financial system, the banking system's got other problems or issues that makes the operating environments difficult. Loan growth is very weak, particularly in the wake of last year's banking crisis. Banks, not surprisingly, tightened underwriting standards, and that's caused loan growth to be weak. Uh, Credit quality, it's okay, but it's definitely weakening, and that's a cost. And then the regulatory environment's tough. No comment
Yeah,
on whether the regulation is good or bad or in between. It's just that
sure.
the regulatory costs are higher. So yeah, I do think the banking system is under a lot of pressure. I doubt the what breaks is going to be related to the kind of duration problems that you described. That was the battle a year and a half ago in March of 2023 when the banking crisis hit. SVB failed, First Republic failed. You generally the thing that breaks is something that you're not looking at. Something in the system that is kind of off the radar screen. The thing that you're looking at probably isn't going to break again, and the Fed could it has tools now to kind of step in and support the banking system if in fact that were the problem. I will call out though that, we may be looking at the wrong part of the system for a problem. It may not be the banking system. It could be the non-bank part of the system. And there's a lot of different things out there that, are worthy of looking at more carefully. I will just mention one thing, put a stake in the ground. The bond market is it doesn't feel it doesn't feel like it's functioning very well. It feels very illiquid to me. When I started looking at the bond market carefully 2, 3 decades ago, a 2, 3 basis point move in the 10-year treasury yield in a given day was a big deal.
Yeah, yeah.
Now it moves 20, 30 basis points seemingly in an hour, depending on events. And that goes to, I think, in part that, the broker dealers that make markets have not been willing or able to expand their balance sheets consistent with the growth in the amount of debt outstanding. And Treasury debt is ballooning because of our large budget deficits. And, it's just more difficult for the broker dealers to consummate trades with their balance sheet and the size of the amount of debt outstanding. The other thing that's going on, of course, is the Federal Reserve is exiting the bond market through quantitative tightening.
Right.
And as they leave, someone's got to come in to fill the void, buy those bonds. And turns out it's mostly hedge funds, not global central banks or institutional investors. It's hedge funds that are very price sensitive. They're there when things are good. They're not there when things are bad. And so that just makes me more concerned that we could see, let's call it a liquidity event in the bond market. It's not only the treasury market, it's also the corporate bond market.
Mhm.
And that could get wrapped up in, for example, next year when, depending on the makeup of government, we could have another debt limit battle. And we also have to figure out what to do about the expiring tax cuts for individuals. So there's a lot of things coming together next year that make me, oh my goodness, I'm looking out my back window and I just saw my dad, the gust of wind came and took my umbrella with it.
Oh, wow.
Took it up 10 feet in the air. It came crashing down. Oh my gosh.
Oh, wow.
It's okay. It's okay. I don't know. That was really freaky. But
Hmm.
anyway, it looked like
Everything is okay.
Mary Poppins flying by for a second. But anyway, I worry about
Yeah.
that, Milan, that we get into next year and we could see some kind of event in the bond market that or crisis in the bond market that will be difficult to navigate through.
Um, and no, I won't belabor this point, but I think you raised some very interesting points. I think I remember the flash rally in I think it was October 2014 where the 10-year moved like 40 basis points in a matter of seconds or maybe minutes. And that was a tectonic move in the bond market at the time. It led to a lot of inquiries from the New York Fed and Treasury about what was going on in the bond market, and that's sparked some regulatory issues related to Treasury clearing and other proposals. But we're seeing it happen quite frequently now, and it's a very interesting diagnosis on what might be causing that. And I wonder, just as an aside, some of the big banks complain about some of the capital and liquidity requirements that have been imposed by the Federal Reserve and the bank regulators, such as the supplementary leverage ratio. And I know that some of them have been lobbying for exempting treasuries from in the denominator there. And so I wonder whether doing something like that would have an effect on the liquidity situation for for these broker dealers that are offering or not offering sufficient liquidity right now. But very interesting issues. And then last macro kind of question I'll ask is uh, how much of the economy do you think is being driven right now by consumer spending? Um, During the pandemic, we saw saving rates jump up significantly and debt levels decrease. But now it seems as consumer debt is skyrocketing again with record credit card debt, auto loan debt, student loan debt. Um, and is this perversely, is this good for the economy? And because it's helping fuel growth, or do you think we have a longer term problem bubbling up here?
Uh, I think the consumer writ large in aggregate is in fine shape, no problem. That the consumer has been driving the train, economic train. By the way, not only here in the U.S. but globally. I mean, the U.S. consumer is buying everything here plus lots what's produced overseas, and that's been key to driving global economic growth. In fact, if you go back to the financial crisis or in the teeth of the pandemic shutdowns, it was China that was leading the way for the global economy. Not now, it's the U.S. economy that's leading the way. So American consumer is really critical. Um, in aggregate, I think we're in good shape. Lots of jobs, low unemployment, wages are outpacing inflation across the wage distribution. Stock market's at a record high, housing values are a record high. So if you're one of the two-thirds of Americans that own their own home, you're benefiting from that. And if you look at overall household debt service, so you take all the debt payments that need to be made by households on cards, autos, student loans, mortgages, home equity lines, consumer finance, the whole shoot and match. Debt service and compare it to income, it's very low by historical standards and stable. It did fall sharply during the pandemic, given all the forbearance and low interest rates, and it has pushed back up, but it's no higher today than it was, in the 10 years prior to the pandemic. So no, and there's a lot of excess savings still, particularly among high income households that they built up during the pandemic that's still sitting in checking accounts that, people are viewing more as wealth than cash to spend, but it's sitting there. And if they need to use it to supplement their income to maintain spending, they've been showing a willingness to do that. Now, having said that, I do think it's useful to make a distinction between households, high income households, middle income households, and low income households. And a good kind of rule of thumb is a third of the income distribution. So the top third of the income distribution, their financial situation is as good as it's ever been. I don't think that's hyperbole. I think they're sitting in very good financial shape. Middle third, okay, not great, not bad, about typical. Bottom third, that's where the problem is. Those folks got, crushed by the high inflation a year or two ago, still paying, a lot more for groceries and for rent. And they did turn to their credit cards and consumer finance loans to supplement their income to maintain their purchasing power, which was one thing when rates were low, but now when you're paying 22% on a credit card, record high, that's a problem. And
Yep.
so that's why we've seen delinquency rates on consumer credit, on cards and on auto in particular rise. But I will say, uh, even there, I think the worst is over. Inflation's back in. Actually, the growth in borrowing has come to a standstill outside of mortgage credit since the beginning of the year. Card debt has not really risen to any significant degree since the beginning of the year. And now with the Fed cutting interest rates, we should see borrowing rates come in and take some pressure off. So I think even lower income households should start to benefit. Now, I don't think the economy can flourish if the bottom third of consumers are struggling. I mean, I think that's a problem, particularly it goes to our social ills and our political fracturing. I mean, I think it's understandable that people are upset about the high prices they're paying for groceries and rent and gas. Particularly folks that are in the bottom part of the distribution of income. But the economy can move forward with the top two-thirds of the distribution. Just one statistic, and I'll stop. The top third of the distribution accounts for 55% of the consumer spending. Typically, it's probably more now, but typically 55% of the spending. The middle third, a pro rata share, about a third, and the bottom third, only 15%. So, the top two-thirds are doing just fine, and they're going to continue to do their thing, and the
Uh-huh.
economy will continue to move forward.
Okay, that's very interesting. So maybe I'll transition into some of the presidential um, policy proposals and get your take on some of those. And I think there's some good follow-up to what you just said. So, um, uh, you know, next year, a number of provisions from the Tax Cut and Jobs Act, Trump's tax law, expire. And if all of them are renewed without change, they're projected to increase the deficit by $3 trillion over the next 10 years. I guess two-part question. One, are we at a tipping point in terms of our debt to GDP levels? I think they're the highest since World War II at this point. And then James Maloney asks that you know, with the likely tax reform next year, are there any key provisions in the TCJA that you think should be extended to support our economy?
Well, I do think our deficits and debt are a problem. We're running a deficit that's 6% of GDP. That's incredibly large in the context of a full employment economy. I mean, we should be running a deficit of 2% of GDP, no more. It's also an issue in the context of the higher rates. I mean, you mix in the large amount of debt with higher rates, we're now paying more as a nation on interest expense than I think on our defense budget, and that's never happened before historically. So I
Yep.
think that's an issue. And if you do the forecast, even any reasonable forecast under current law, which includes the expiration of the Trump tax cuts for individuals, it's pretty daunting. I mean, out 30 years from now, the debt to GDP ratio, I'm making up the number, but roughly 170% debt to GDP, something like
Yep.
that. A good rule of thumb is that every percentage point increase in the debt to GDP adds a basis point, maybe two, to long-term interest rates. So you can do the arithmetic. And the world, of course, is very nonlinear, meaning, it's one thing when you're at 100% debt to GDP. It's
Sure.
another thing when you're at 150% debt to GDP. At that point, every percentage point could add 3, 4, 5 basis points. And at some point, it'll break. It's not sustainable. That what that means is at some point bond investors are just going to say no more. You got to pay me, the U.S. Treasury, a lot more in interest to take on the risk that you're not going to pay me back. That's probably going to happen around a matter of governance, like a debt limit battle or a battle over keeping the government open, which may be next year, could be next year, it could be 10 years from now, it could be 15 years from now. I don't know, but it's going to happen. There'll be, that may be when the bond market freezes and the interest rates spike. That could be.
Mhm.
Now, I'll go so far as to say that perhaps that's what's necessary to actually make the policy changes necessary to make our fiscal situation sustainable. That at the end of the day, without a crisis, without something forcing us to make some tough decisions around taxes and spending, we're not going to make them. I mean, in all fairness to our lawmakers, they unless the electorate's demanding it, they can't do it. There's just no political will. But if the bond market is revolting, just like the back in the 90s, the bond market vigilantes come back.
Yep.
And, the future Secretary Rubin, who was Treasury Secretary under Clinton, could point to that and say, hey, guys, if we don't make some changes here, this is our future. I don't think we can do it. So I think, we almost need a crisis to, push ourselves to be able to do something to address these issues. Now, with regard to the TCGA expiration, Milan, my guess is, you know, under most scenarios, that's just going to be, those tax cuts are just going to be extended as they are right now. I don't think there's the political will or, to allow those tax cuts to expire in any meaningful way. There might be some on the margin, some tax increases on the margin, but that'll be exchanged for some tax cuts, elsewhere. And the net of all that won't
Yeah.
be really any change. I think it's just a pretty heavy lift, to politically to allow those tax cuts to expire in any meaningful way. So I think that's the most likely path forward. If I were king for the day,
Yep.
we obviously need to address our fiscal situation. And, one of the steps to get there is we do need more tax revenue, and that has to come from higher income, higher net worth households and corporations. And I'm sympathetic to that perspective. So I think, if I were king, I would allow those tax cuts the TCJA tax cuts to expire for folks that make over 400K, as Vice President Harris has articulated. But I think the prospects of that are pretty low under most scenarios for what the government's going to look like on the other side of the election.
That sounds right, and unfortunately, I wouldn't be surprised if they lard up, the vehicle with additional
Yeah.
giveaways and tax revisions there that are going to exacerbate the fiscal situation. And I tend to agree with you about needing some kind of crisis or break in the system to force some kind of compromise and realignment in terms of our fiscal policy, because right now the easy move just appears to be kick the can down the road, raise the debt ceiling, issue more debt, and continue to cut taxes for basically everybody, without making any hard decisions,
Yeah.
and continue to spend, by the way, on the other side of the ledger. Yeah, I think I remain deeply concerned. I wonder if one of those breaks would be, in addition to what you've articulated, uh, a migration away from the dollar as the reserve currency. And I know people speculate about this often, that uh, you know um, so the Saudis will create a petrodollar, or that China and will team up with a number of developing countries to create a rival currency. I think at times there have been concerns about the BRICS countries, maybe teaming up to do something to denominate, a common currency. But I know in practice that would be very difficult. Maybe I'll try to weave in. There have been a couple questions about tariffs. John Manger asks, if you could address the effect of Trump's proposed tariff policy in a second term. And, uh, you know, Donald Trump has vowed to impose a universal tariff of 10 to 20% on all imports, a 60% levy on Chinese goods. Some days he says 200%, 500%, a 200% tax on automobiles made in Mexico. What would the impact of all of this be on the US economy and consumers, and including inflation? And does that type of move then lead to a break in the system, maybe to force people, maybe investors, to think twice about being in the United States?
Yeah, I'm not a fan of a universal or broad-based tariff. And of course, I'm not alone. I think if you put 100 economists in a room, 98 would agree. Then there's maybe two that wouldn't agree, and I'm not sure who they are, but you'd find somebody. So there's broad-based skepticism around that kind of policy. I mean, it's just a tax increase in another form, and the problem with it is, it's a tax increase on low and middle income Americans. I don't know why you would
Exactly.
want to do that, because a higher share of their budget goes to the imported products that will have to pay a higher price because of the tax, because of the tariff. The other thing is, that really makes me nervous about tariffs is the implementation. If you go back to the Trump tariffs in his first term, you get a sense of how that works. The administration formed I'm going to use the wrong word, but it's descriptive, a board of government officials that adjudicated petitions that came from businesses with regard to the tariffs, and they would decide, who had to pay the tariff, which products, which companies, over what period of time, which countries, that's that's crony capitalism, at its worst. It
Yep.
creates a whole lot of uncertainty, and really will mess with supply chains, investment decisions. It'll make the economy, long run work much less efficiently, and reduce productivity growth, not enhance it. And then, the other thing to consider, which, I think is critical, is the other countries aren't going to sit on their hands. They're going to respond. I mean, some countries more than others. China will be tit for tat. Mexico sounds like it might be tit for tat. Canada
Hmm.
might play it, a little bit more coyly, but the world is not going to stand still. They're going to respond, and that's going to diminish the very industry that the former President Trump is arguing he's trying to help, and that's manufacturing. So I think it's just, if I could pick a policy that is going to do a lot of damage to the economy, nothing better than a tariff. It's just a really bad idea. And I think we saw that in his first term. I mean, people, I heard this argument, well, what about his first term? Well, the first thing I'd say that was tariffs on 300 billion plus in imported goods, mostly from China. Here he's talking about tariffs on, $3.4 trillion in imports across lots of different countries.
Yep.
And the other thing I'd say is go look at history. Those tariffs were being implemented 2018, 2019. By the second half of 2019, President Trump was doing everything could do to kind of paper over the impact. He was cutting checks to farmers to kind of compensate the farmers for the costs of the impact of the higher tariffs on their business. And he was already trying to negotiate a retreat on the tariffs with the Chinese. We will never know, how this all would have played out because the pandemic hit in March of 2020. But I'm pretty confident that if there had been no pandemic, we would have seen full bore how bad an idea that was and how much damage that was doing. And that was 300 billion. And then other people will say, one other argument is, well, he's not going to do 10% or 20%, certainly not 60% tariff on Chinese imports. Yeah, that I'm sure you're right. I mean, I'm sure a lot of this is just political bluster and politicking and signaling and maybe some negotiation. But the one thing I did learn from 2016, the 2016 election and the policy that followed in the first term of under President Trump was he's going to do what he's going to do what he says he's going to do. He's going to do it. He's just not
Exactly.
going to do it to the degree that he says he's going to do it, but he's going in that direction. And so I don't think you can count on, or should expect that we're not going to get broad-based tariffs. We're in all likelihood going to get broad-based tariffs. So I don't know, Milan. I just really worry about that. Of all the policy proposals that the former president put forward, that's the one I really have a real difficult time with.
I think a lot of us are very nervous about it. And I saw Larry Summers commented that it would create a double-digit inflation in the country. So there are concerns about inflation. What happened in 2022. That would be even worse. We have 10 minutes left, so I'm going to try to do, maybe Mark, we could do a lightning round. I got
Yeah.
maybe three. I'll try to see if we can get like three questions in. There's some interesting then ones that have been posed here. I do want to hit one topic that you and I have worked on together for many years, which is housing finance reform and also affordable housing. And kind of two things. One is we've had since the government stepped in 2008 to put Fannie and Freddie into conservatorship at the height of the housing crisis. They've been basically wards of the taxpayer, and there have been some nascent steps over the last decade to try to um, uh, you know reform Fannie and Freddie and then recap and release them or privatize them. Uh, do you think that GSE reform, reform of Fannie and Freddie and privatization can be done in a way that preserves access to affordable housing? And do you have a preferred approach? I know you've come up with proposals in the past with Jim Parrott. Do you have a preferred approach today to that? And then kind of an ancillary question. Um, Technology exists to significantly reduce the cost of housing, for example, manufactured housing. But it seems like antiquated zoning laws at the local level, are an impediment to this. What can be done to increase broader adoption of those types of solutions to bring more affordability to the housing market?
Yeah, lightning round on GSE reform. Well, I think a straight up privatization of Fannie and Freddie will fail. I don't. I think it'll be too disruptive, and I'm not sure what problem you're trying to solve. I mean, the housing finance system, Fannie and Freddie have been in conservatorship since '08. A long time, a generation, and the system seems to be working just fine. There's a lot of moving parts there, and the ecosystem is very deep and broad, and it feels healthy to me. If I were king, I'd make some changes, but to try to make it
Mhm.
work better. But in the grand scheme of things, we got bigger problems. So I don't know. Why are we even trying to go down the privatization path, the pure privatization path, when things are working just fine, and we've got a generation where it has worked fine. So it gives us good sense that, that should continue to be the case. But having said that, I would argue that we should codify the conservatorship and turn Fannie and Freddie into government corporations that are owned by the government, can have boards of directors where they have some private investment stakes in the companies to ensure that they remain focused on the marketplace and remain attuned to demands coming from different stakeholders in the ecosystem. In fact, if you go back pre-1968, that was Fannie Mae, and Fannie Mae was a government corporation. It worked just fine. I'd go back to the future and codify it. And the reason I would do that is because you could bring down interest rates even more. I mean, there's still, in the current system, there's still some issues
Spread.
with whether the Fannie and Freddie has the full faith and credit. And
Yep.
if they're in a government corporation, they do, and you can get interest rates down, not a lot, but 10, I'll take every basis point I can get given housing affordability. So that's the way I would go. And as you said, Jim Parrott and I, with Gene Sperling and Barry Zegas, wrote a series of papers that I think still hold, that you might want to Google, that you can take a close look at it. It kind of lays out the path. Uh, I agree with you on the kind of the modular manufactured housing. We really, those are relatively low cost, and they're nice homes, and they can put them up very quickly. But zoning and permitting is an issue. And I just don't think sticks will work here, because these are zoning rules that are made by local governments, and if the federal government tries to come in with a stick, like for
Mhm.
example, withhold transportation funds unless you do something. I don't know. That feels like you're going to be tied up in the court system for years and get nothing done and piss everybody off and just not accomplish a thing. Uh, but there are efforts to use carrots, and although it, costs money, there's carrots, so-called innovation funds that have been put forward. I know a few senators have put this forward, and the administration Harris has, and the idea is you give carrots to local governments in the form of infrastructure money, parks, school money for schools, things to improve the infrastructure of the community you're in if you make the appropriate changes to your zoning and permitting rules. And I think that's worth a shot. See how well that goes, how effective that is, how efficient it is, how costly it is. Do, pilot on that, a meaningful pilot,
Mhm.
20, 30, 40 billion dollars, and see how that works. Because that may be the way to go here to really incent, people to move in the right direction on the permitting and zoning. But I totally agree with you. That's the key issue here. There's many impediments to housing supply and getting more supply, and goodness knows we need that. That goes to the affordable housing crisis, both for rent and for home ownership. But I'm just very skeptical that a stick will work.
Okay. That's actually super helpful and very interesting ideas to explore. Uh, I'm going to go to a question we just received. A lot of talk about industrial policy and competitiveness in the EU and the UK compared to the US. What are your insights on this and how it'll affect our relationships with these nations or nation bloc? So I think that probably references some of the policies in the Inflation Reduction Act where the EU is quite upset about some of the incentives that the US has put in place for electric EVs and kind of investment in the climate space.
Yeah, no, it's a good point. I mean, I am a fan of using what I guess we're calling industrial policy. I mean, yeah, again, I view it in part as national security. I mean, we're focused on things that are critical to our national security. The chip industry is just vital, and
Hmm.
we need that here. We need to address climate risk, the Inflation Reduction Act. In the infrastructure, we need infrastructure. That's straight up, what government should do, and we need that. And so I think the use of more targeted fiscal policy, which some are calling industrial policy, is entirely appropriate. Again, particularly in the context of, national security. And I understand there's a political economy of it that, particularly in the current environment, you want to make sure that the benefits of that are accruing to the taxpayers who are paying for it, right? Because we are paying for this. I mean, this is, we're running these deficits and we're paying taxes, and we need to be cognizant of that. And so I get it. I'm hopeful that, as economies continue to repair and improve, and hopefully we can maintain full employment for an extended period, that these, concerns about America first, buy America, fade a little bit, and we can start thinking about our more carefully about our allies and other countries that are in this with us together. And the EU and Canada and Australia, Japan, obviously are. And we want to make sure that, we don't harm those economies, and that, they flourish along with us, because our future success, both economically and geopolitically, militarily, depends on those economies as well. So, I do think that should be a consideration, and hopefully we can move in the direction of, allowing them to participate more fully in the things that we're doing.
Let's see, we've got 1 minute left, so I'll see if I can. We'll end on this one. As an economist, what do you make of the electronic betting markets? Do you think that they have more predictive value than traditional polls?
I don't pay any attention to the polls. I do look at the betting markets. Yeah, I think there's some value there, and they're getting more liquid and deep, and I think they're more useful than the polls. So yeah, I pay attention to them. In the current election, though, I'm not. It's a toss up. It's going to depend on what idiosyncratic events that happened in, my home. I'm in suburban Philly. What happens here, if there's snowstorm or whatever, this is the kind of things that's going to determine how this election plays out. So buckle in.
Yeah. Well, Mark, thank you so much. You've been very generous with your time. This has been a fascinating discussion and a lot of tangents that I would have loved to have explored further. But as always, a very stimulating conversation. I want to thank you for taking the time to join us, and very much look forward to staying in touch.
Well, thanks, Milan, and thanks for the opportunity. And I appreciate the great questions. They were very thoughtful, and thank you for that. And look forward to crossing paths again soon. Take care now.
Take care, everyone.